Welcome to the Deep Dive. Today we are jumping into our Talk Tickers format, and we're zeroing in on a really interesting corner of the financial world. We're looking at Cathay General Bancorp, ticker CECOY, and specifically their Q4 2025 earnings call from, just a couple days ago, January 22nd.
Yeah, and it's a fascinating one. I mean, usually earnings are pretty straightforward, right? Good numbers, stock goes up, bad numbers, stock goes down. Cathay sort of decided to flip that whole script on us this week.
That's it. That's the central mystery we're here to unpack. You've got this regional bank that beats on earnings, smashes revenue, raises its guidance, and buys back a ton of its own stock. And the market's reaction, a 3% drop the next day. So the question is simple: broken stock or broken market?
It really feels like a major disconnect, because when you actually peel back the layers of this report, you see a bank that is executing almost perfectly, especially in, a very messy environment. But the market seems to be pricing in a completely different set of risks.
Okay, so before we get into the market psychology, let's just lay out the facts. Let's hit the headline numbers, because on paper, this thing looked like a home run.
Oh, it really was.
Yeah.
Let's start with the bottom line. GAAP earnings per share, it came in at $1.33. Now, the consensus on the street, what all the analysts were expecting, was $1.23.
So they didn't just squeak by, they beat by a full dime.
A full dime.
Yeah.
And for a regional bank, that's not a rounding error. That's an 8.1% beat. That is massive. It tells you their operations are way more efficient than anyone was modeling.
And it wasn't just, cutting costs to get there.
No, not at all. The revenue number was, I'd argue, even more impressive. They brought in $222.8 million for the quarter. Wall Street was looking for something like $211 million. So they basically down an extra $11 million in revenue the market just didn't see coming.
And if you look at the growth from last quarter, it's even crazier. Net income for Q4 was $90.5 million? That's up 16.5% from Q3. So we've got growth, we've got revenue, we have profit. Why on earth did the stock close down at $50.73? Why the long face? Wall Street.
Well, to understand that pessimism, you have to look past the headlines and get into the engine room. And for a bank, the engine is always the net interest margin, or NIM. The spread between what they earn on loans and what they have to pay out on deposits.
Right, and that's the number everyone's terrified of. The fear is that with the Fed moving rates around, that margin just gets crushed. Banks have to pay up for deposits and profits just evaporate.
That is the big fear. But here's the kicker for Cathay. Their margin actually expanded. NIM rose to 3.36%. That's up from 3.31% in the quarter before.
Okay, so 5 basis points. I know that sounds tiny to a normal person, but on a multi-billion-dollar balance sheet, that's everything.
It's pure profit expansion. It means they're finding ways to charge more for money while keeping a lid on what they pay for it.
But is that sustainable? I feel like every time I see this, a bank has one good quarter on margins, and then management gets on the call and says, yeah, enjoy it while it lasts.
See, that's the twist here. Management did the exact opposite. They are guiding for NIM to go even higher in 2026. They're projecting a range of 3.4 to 3.5%. They're telling the market, we've bottomed and we're on our way back up.
That is incredibly confident. I mean, given the macro environment, how are they planning to pull that off? If the Fed cuts rates, which is what everyone expects, doesn't that just kill the margin automatically?
Not necessarily. It all comes down to this concept they call deposit beta. It sounds really technical, but
break it down for me.
Think of it like a pain threshold.
Yeah.
Management is modeling a beta of 60%. So if the Fed drops rates by, say, 1%, 100 basis points.
Right.
Cathay believes they only have to lower what they pay their depositors by 60 basis points. They think they can keep 40% of that rate cut for themselves.
That seems optimistic. I mean, usually when rates fall, customers will pull their money and run if a bank lowers its payout too fast. Why are they so sure they can get away with that?
Okay, so this is where their specific business model, their niche, comes into play. They have a very targeted strategy, and it all revolves around the Lunar New Year.
Wait, stop. The Lunar New Year. We're talking about complex interest rate hedging, and their secret weapon is a holiday.
It sounds strange if you're not familiar with their demographic, but yes. For Cathay, it is a massive, massive liquidity event. They're one of the top Asian American banks. The Lunar New Year is a time of huge money movement. Gifts, bonuses, businesses settling accounts. Cash is just in motion.
Okay, so how do you weaponize a holiday for your balance sheet?
Well, they have almost $4 billion in certificates of deposit CDs that are all maturing in the first quarter of 2026. Right now, those CDs are paying at a pretty high rate, about 3.8% on average. That's expensive money for the bank.
$4 billion that they're paying top dollar for. Got it.
Exactly. So their whole goal is to reprice that $4 billion lower. They're launching a specific Lunar New Year campaign to keep those customers, but roll them into new CDs that pay a little bit less. They're using that cultural moment of reorganizing your finances to reset the price on a huge chunk of their deposits.
That's actually pretty brilliant. So while other banks are just sending out generic mailers, Cathay is using a cultural event to say, hey, Happy New Year, let's roll this over. And they shave a few basis points off their cost in the process.
That's the plan. And if they can pull it off, that $4 billion instantly becomes cheaper, which directly boosts their net interest margin. That's where the confidence for that 3.5% guidance comes from.
Okay, so the margin story is clever. I'll give them that. But that's only half the battle, right? You can have the best margins in the world, but if your loans go bad, the bank still blows up. We have to talk credit quality.
Right, and this is usually the scary part of the call. And on the surface, it looks great. The money they set aside for bad loans, the provision, it dropped to $17.2 million. That's down from almost $29 million last quarter.
Which suggests they're less worried about defaults. But I was digging through the transcript, and there's a line item that made me pause. Special mention loans. That number went up to $535 million. That's over $500 million.
It is a big number, yeah.
So special mention, that sounds like a very polite banking term for we're in trouble. Is this a loan that's already gone bad?
Not yet. That's the key distinction. The borrower is still paying, but the bank's internal alarms are flashing a yellow light. You know, maybe the borrower's revenue dipped or some piece of collateral lost value. It's the bank saying, we need to put a manager on this account full time.
So it's the watch list. And $500 million on the watch list feels like a pretty big red flag, even if the provisions went down. Did they explain what's in there?
They did, and you have to give them credit. They were very transparent. They didn't just hide behind macro headwinds. They broke down the actual loans. And when you look at them, they feel like one-off issues, not, systemic rot.
Okay, give me an example. What's one of these problem children?
So the biggest one is a mixed-use commercial project in New York. The building is finished. It's occupied. Tenants are in there paying rent.
So, what's the problem?
Bureaucracy. Yeah. Red tape. They're waiting for a specific property tax status approval from the city. And because that piece of paper hasn't cleared yet, the property's tax bill is technically higher than it should be, which then messes up the debt coverage ratio, the math that says the rent can cover the loan payment.
So the building is fine, the tenants are fine, but because a form is stuck in a filing cabinet somewhere in City Hall, the bank has to flag a massive loan as being at risk.
That's basically it. Once that tax status gets approved, the ratios fix themselves, and the loan probably goes right back to past status. It's a technical issue, not a fundamental one.
Okay, that makes me feel a little better. What else was in there?
There's a C&I loan commercial and industrial to a distributor of exercise equipment.
Exercise equipment, oh boy. That whole industry's been a roller coaster since 2020.
It really has. This company just had a bad quarter, which tripped one of the covenants in their loan agreement. But management specifically said on the call they expect the company to be profitable for the full year. It sounds like a temporary inventory issue, not a looming bankruptcy.
So a tax delay and a slow quarter for treadmills. These don't exactly sound like the start of another 2008.
That's their argument. These are solvable problems. And the fact that they lowered their overall provisions tells you they believe these loans are going to get healthy again, not get worse.
All right, let's pivot to what the bank is doing with its own money. Because while the market was busy selling the stock down to $50, management was out there buying it with both hands.
This is maybe the strongest signal in the whole report. In the fourth quarter alone, Cathay bought back 1.1 million shares of its own stock. They spent almost $52 million doing it.
That's a serious amount of capital return.
It is. But look at the price they paid. The average price was $47.15.
$47.15. So the people who see the loan book every single day, who know about the deposit flows and the tax delays in New York, they looked at their own stock at $47 and said, this is a bargain.
And they're not done. They have about $12 million left on their current buyback program, and they said on the call they plan to announce a new one right after this one ends. They are reloading.
This basically creates a floor under the stock, doesn't it? It's like a Cathay put. If the stock drops into the high 40s, you know there's a huge price-insensitive buyer waiting there.
It absolutely changes the risk profile. When a company is this aggressive buying its own stock, it puts a real damper on volatility to the downside. They're defending their own price.
So let's recap. We have growth, we have margin expansion, we have what looks like solid credit, and we have massive buybacks. I have to go back to my original question. Why the 3% drop? If everything is so good, why did the stock fall?
I think it's two things. One is, let's say, valid, and the other is more psychological. The valid one is the executive shuffle.
Ah, right. The CFO is retiring.
Yes. Hang W. Chen is retiring on March 1st. He's been there a while, a steady hand. The new guy, Albert J. Wang, is taking over. Now, it looks like a smooth transition, but Wall Street hates uncertainty, and a new CFO is always an uncertainty. Will he be as conservative? Will he change the accounting? It adds just a little bit of risk.
New guy risk. Okay, fair enough. What's the psychological part?
It's the classic sell the news phenomenon. You got to remember, the Cathay stock was up over 11% in the quarter leading up to this earnings call. It was crushing the sector ETF, the XLF.
So the smart money already made their bet. They bought it expecting a good report.
Exactly. They bought the rumor. And when the news came out and it was good, but not, we discovered gold in the vault, good, they just took their profits and moved on. It's not a critique of the company. It's just how the trading game is played.
It also feels like there's just this broad skepticism about all regional banks right now. The market just doesn't believe anyone can hold margins if rates get cut. It's like the market is saying, we don't care about your clever Lunar New Year strategy. We think the Fed is going to crush you anyway.
That's the macro headwind. The market is betting on the whole sector getting squeezed. Cathay is betting on its own specific execution. And that's the tug of war you're seeing in the stock price.
Which brings us, of course, to the moment where we stop being analysts and start being armchair traders. It is time for our This Is Not Financial Advice segment.
My favorite part.
And as always, to everyone listening, we are just two people talking into microphones. We are not your advisors. This is purely a thought experiment. Do not do this. It's a way to test a thesis.
So, lay it on me. What's the crazy idea today?
Okay, I'm calling this one the buyback beta arbitrage.
Ooh, that sounds fancy. Break it down.
All right, look at the setup. You have Cathay, trading around $50. We know for a fact that management sees deep value at $47 because that's where they're buying. We also know they're confident in expanding margins to 3.5%.
Right.
But the market hates the whole sector. The market thinks all regional banks are in for a tough time. So how do you play that disconnect? You go long Cathay to bet on the company's execution, but you go short the XLF, the Financial Select Sector ETF.
Ah, interesting. So you're hedging out the general market risk.
Precisely. If the whole banking sector falls off a cliff because the Fed does something crazy, your short on the XLF should make money, and that cushions the blow on your Cathay stock. But if the sector just kind of treads water, you're betting that Cathay will outperform the index because of that buyback and that margin story.
You're isolating the alpha, you're stripping out the market and making a pure bet on Cathay's management being better than the average bank's management.
Yes. You are betting that their Lunar New Year deposit strategy actually works and that the buyback puts a firm floor under the stock. You're playing the spread between this one high-performing bank and the generic index.
It's a classic pairs trade. You're trying to capture that disconnect. It's aggressive, but if their NINUM really does hit 3.5%, then mathematically the spread between CD and the XLF has to widen.
That's the trade. And again, probably a terrible idea, please don't do it, but it just perfectly highlights how strange the situation is. The company's fundamentals and the market sentiment are on two different planets right now.
It certainly feels that way. It's going to be a fascinating one to watch for the next few months.
And we will be watching. Keep an eye on that March 1st date for the CFO handover. That's the next soft catalyst. Until then, we'll see you when the ticker tape starts moving again.
Thanks for listening to The Deep Dive.